Good morning, everybody. We're just going to give it another 30 seconds. People are trickling into the meeting, then we'll kick it off. Okay, good morning. Welcome to the October 7 Bridge webinar. So I'm going to share my screen and we'll go ahead and get going. Great. So just kind of by way of reminder, so there's some new faces on the call today. I'm Justin Ferraccio. I'm one of the partners here at the firm. This is Chuck Eberly joining me.
Morning, everybody. Morning.
It's one of the rare times we're not sitting beside each other, but we're both here, ready to operate. Um, this webinar kind of was born out of the idea of us doing some sort of newsletter or some sort of monthly communication with our clients and friends of the firm so that we give them kind of updates on what we see happening in the economy. We'll cover a range of topics. We'll have guest speakers, all kinds of different things that are hopefully entertaining and educational. Always welcome to come up with ideas and send them to us. Pre-submit questions. If you have questions during the webinar, you can submit them to the chat. They'll come to me directly. You'll remain anonymous with the group. So from there, here's the agenda for today. Already crushed the intro. We're going to talk about market performance. AI, is there a bubble approaching in the AI space? That's a question we've been getting a lot, and it's one that we're spending a lot of time trying to get an answer to. Is growth slowing in the economy? Will the Fed cut rates, which we've touched on previously, but we're just going to, give you our most recent thoughts and then questions. So, year-to-date market performance, we're more than three-quarters of the way through the year now. The Dow is up 8%, S&P 500 is up 13%, NASDAQ, which is more tech-focused, is up 17.5% in the year. Russell 2000, which is more small and mid-cap companies, is up 10%. Equal weight S&P, which basically takes the 503 stocks in the S&P 500 and weights them all exactly the same. So it gives you a more accurate representation of what's happening with all the companies across the S&P. That's up 6.7%. And the bond market is up nearly 4% now on the year. So not a lot of major changes month over month. Things continue to trickle forward. There continues to remain high volatility, right? It's not a steady stream up, but that's definitely the trend line we've seen this year. But how we're getting there is different than typical, right? We've had a lot of downs, a lot of ups. Even last Friday to Monday to today, we're seeing 3% swings, basically each of those days. So, okay. So, like I said, it's been a strong year so far. So, despite volatility, tariffs, trade policies, retail sales, business spending remains strong. So, what's driven this rally of the S&P and the broader stock market in general? It's largely AI enthusiasm. We've talked about that many times before. Expectations for lower interest rates, solid economic growth, and the lack of impact on tariffs. So those factors have continued to power stocks higher, but I think it's important to remember that all four of those things have powered stocks and have done good things for the market and the economy, but they all come with risk and with question marks. With that being said, an AI bubble, the talk for that is getting louder. It's possible that growth is starting to slow. There's whispers that the Fed may not cut rates as much as expected, and obviously there remains uncertainty around tariffs. But for right now, the purpose of this slide, AI is what's driven the market this year. It's the CapEx spend, which we'll touch on next. Right. So capital expense boom around AI infrastructure has reached multi-decade highs. Major tech firms continue to pour cash into building out data centers and other AI infrastructure. And I just put some news clippings on the left-hand side because every time you open the newspaper, online looking at news, it's just constantly articles about spend, OpenAI and Oracle $300 billion Stargate deal. It's constantly, all you'll see is companies pouring money into each other, it seems like. So it's NVIDIA and Oracle and all these companies are kind of, it's almost a circular motion of where the money's going. But if you actually look at the numbers from a valuation standpoint, AI is not in a bubble. Price to earnings growth is kind of what we're looking at here. And if you do the math on it, we actually find that most major tech companies trade below the price to earnings growth ratio of the S&P 500 in the broader market. So, even though valuations have pushed extremely high, price gains are extremely high, it's largely because earning growth is also extremely high. And so we're not seeing any ratios that make us nervous at this point. That being said, we've said this before, we don't have a crystal ball. We can't predict what the stock market's going to do. This is our best estimate of what we see happening with today's data, right? So we want to continue to own all these companies. We want to own NVIDIA, Microsoft, Oracle, Broadcom, but we don't want to own them, at 6, 7, 8%. We want to own them at 2, 3, 4%, right? So we want to have exposure to these companies so we don't miss out on upside. But at the same time, we want to control that exposure so that if there is a market event, a correction, if CapEx slows in AI spending, we want to make sure that we're protecting your portfolios and doing this with as low risk as possible. Chuck, anything you want to add to that before you?
Yeah, I think one thing, if you think back to the 90s and the dot-com bubble and kind of how that happened, it's very similar. I think, something we hear all the time is, while it's different this time, it's typically, or it's not different this time. It's very similar, even though the words to the song might be different, the rhythm's the same. Because we get a lot of questions about, well, why do we own, a consumer company or a healthcare company? Why don't we have more AI? And those are the things we heard during the dot-com time. Why do we have Home Depot? Why don't we have more AOL? We're getting those questions now, and it's kind of like a falsehood to think that what's going on with AI is going to grow without interruption or problem. AI is definitely not be a part of our lives. We don't know what it's going to look like. It's going to be profitable, but it's not going to be a straight line. It's going to be volatile. All it would take would be announcements of CapEx in AI slowing it, and then you're going to see a big correction in it. So we just want to be careful with it. We want to participate. We don't want to become too concentrated because we don't want the volatility, and there's going to be volatility with these stocks. Okay, this is kind of a summary, from last month's webinar, where we were looking at, is growth slowing? So as a confirmation, we're kind of in the same spot. We're not in an expansion time, but we're not in contraction. So all the data with growth is checking in that, it's stable, contracting slightly, but not a problem at this point. On to the next one, Justin. So if we look at, business spending, retail sales, those are all coming in strong and in line and supporting the market. Jobs aren't showing a problem. There's some news stories about the job market, but really we're not seeing it with the numbers. Unemployment rate's good, and really not indicating an economic slowdown. Hiring, not hiring, not firing labor market. So it's a stable market. There's still, plenty of job openings. It's not showing that there's excess there, but also not a shortage of job openings. So everything's kind of checking off that everything's okay with the employment numbers. And is growth slowing? Right now, no, not yet, but it's a big question mark. The jury's still out on is growth slowing, which kind of leads to what the Fed's doing. are they going to continue to cut? So when we get these numbers, if the growth is too hot, well, then the Fed won't cut, and that'll be a problem for the market. If it's too slow, then we're worried about a recession. Then the Fed might have to play catch up. So we're kind of sticking with what we talked about last meeting, which is we do see a number of cuts here in the next year. That's still in play. We expect Fed funds to get near 3%. So really no real big change, just kind of confirming the numbers we talked about last time.
Great. Thank you. All right, I'm going to stop sharing my screen and we can get into some Q&A. And Chuck, if you want to kind of start with succession planning.
Yeah, Justin and I, we get a fair amount of questions from clients during review meetings talking about kind of the future of Seven Bridge in the firm. And I've had these discussions with many of you when we're one-on-one having, talking, but we thought it'd be good to talk about what's in place for a succession plan at Seven Bridge. So succession is not something that you do last minute. I just turned 63, so I'm not a spring chicken. I'm not over the hill, but I can see the hill. So Justin joined the firm about 5 years ago. He was part of that succession plan. Evan joined the firm. He's a few years younger than Justin, so we do have good age diversification. As far as an old gray-haired guy and then middle-aged and a younger advisor at the firm. A promise that I made to each of my clients, and I think it's universal across the firm, is that our clients have entrusted us with advice, and we look at it as our job to have the right people in place for us to vet the right people, so that at no time would we be making a phone call to say, hey, I'm retiring, you need to find someone new. We want to have those people in place. One thing that we identified when Larry retired is that we were not doing a good enough job of making sure the clients of the firm know the other advisors and people at the firm. So we're making a conscious effort that you're getting to know, people that primarily work with Justin get to know me, they get to know Evan. They're part of the solution set. That way it's, we do view that every client of the firm is serviced by everyone at the firm. So if you call me and ask a question, hang up and call Justin, the way we run the firm, you're going to get the same answer, from me, Evan, or Justin. So this is something that if you have questions about it, please bring them up. But we are working hard to make sure that the next generation is in place. Justin and I were just at a conference last week in Chicago with, it was an industry conference, and they pointed out about 80% of firms, the average age of the owner of the firm is my age, and 80% of them have no second generation in place. So, not that we're unique that we have it in place, because we should, but most firms don't. And I view it as a problem if you don't. Anything you want to add there, Mr. Justin?
No, I think you nailed it. And we've gotten that question a few times, so I think it's important we address it with the broader group, that it's something we think about and talk about all the time, and we take it very seriously. So we'll continue to work on that and look forward to answering questions around it as we move forward. But the important part is Chuck is not leaving anytime soon. We're just trying to get ahead of it and put 5 to 7 year plan in place. So we do have one question, which is going to be a tough one to answer, but I'll let you take a stab at it. What data points will you be looking for if the Fed data becomes unreliable due to funding and staffing cuts?
Hmm. I, I kind of question the data to begin with, because it's always revised. And I think, kind of garbage in, garbage out happens a lot. It's not like, I don't necessarily think there's manipulation of the data. Um, the good thing is now there's a lot of other data points out there, other, non-governmental, like the ADP unemployment surveys and, many other surveys going on out there to give us an indication. Um, question's gonna be, I think if we were thinking of a long-term government shutdown, that it would have a bigger impact. I think there's gamesmanship going on right now. I don't see this lasting so long that we are thirsty for data. I think it could have a short-term impact, but long-term, I think there's gonna be enough data points that, get an idea of what's going on. I mean, the trouble is you get these data points and then something different happens. So they're really just data points to help us understand. And in the end, it's still a cloudy picture. I think, what we do is, diversify your money, own quality, um, for virtually any environment we're in. So we have to do what, kind of what the strategy dictates, which is own quality, diversify. Um, and that's what really protects us, because in the end, the data is on a, when a problem happens, you kind of look back and you can see it. When you're looking forward, it's hard.
Yeah, I think, one thing I'll add to that, there is private data out there that we pay attention to and monitor, but also this data doesn't move at lightning speed for the most part, right? It's not like the job data is going to change by 20% month over month. It'll move. We see trend lines, but if we are missing data for a month or 2 months, which I don't think will happen, we do have private data we can leverage. But at the same time, this data it moves, it trends, but it's not lightning quick. So we'll be able to catch it before we get into any real problems. Let's see. Another question, do you see Bitcoin continuing to run up? Which is a great question. I think the firm view on Bitcoin is we're looking at it as a long-term asset hold, right? So yes, I it's a hard question to answer because I have no idea what Bitcoin's going to do today, tomorrow, next month, next year. But I am convicted, and I know Chuck is too, that if we look at Bitcoin in 3 years, 5 years, 10 years, we think it's going to be much higher than it is today, right? So it's a more volatile asset to own. I do think it's important to own it, but to own it at, you know, a percentage amount of your assets where if it does get cut in half, it doesn't hurt you. But if it does 5 or 10x, it's impactful for you. So it's trying to find that fine line for everybody, which is usually, somewhere between 1.5% and 3% of your liquid investments. But I think we have to look at Bitcoin on a long-term outlook. We can't, you know, it moved 15% Friday, right? Like that's still going to happen with Bitcoin. It's gotten more and more stable over the years, but it has the ability to move quickly in either direction. We just have to look at it over the long haul, and I think we're all convicted here that it's going to continue to move up over time. Okay, thoughts on China-US tariff situation? Who wins? Chuck?
I don't know. Yeah, I think what's, uh, troubling, or, just how quickly things can change. Before Friday, it wasn't, it was kind of on our radar, the tariffs. And then we have a big change. So, I think it changed in some aspects in the negative. I think it could just as quickly change to the positive. So I think there's a lot of, I guess, deal making going on, because you get this big tariff increase, mainly for what's going on with rare earth materials. Um, China's withholding that. That's definitely a national security issue as well as, everything with AI. Rare earths are involved. So I think it's a negotiation tactic that could just as quickly change the other way. And I don't think it's anything that we can really anticipate where the next move is. So I think it kind of goes back to my earlier comment. We got to, remain diversified with the sector's own quality and manage risk because, things can change in a moment, just like they did on Friday, and it kind of looked like for some reason everybody thought the all clear button was pushed, that it's safe to go back into the water yesterday, but now it's not safe to be in the water today. So that's kind of the environment we're in right now. So I think it's not a time to change your strategy or become very aggressive or conservative right now. It's kind of, tomorrow's news could be completely different with tariffs.
It's
Change on a dime.
moves quick. Okay, we'll get to one more question, then anything we don't get to, we'll reach out to you directly. But why is CapEx what we're monitoring to determine whether AI growth is slowing? Are we also monitoring other items like revenue, or is it primarily CapEx? And so, we talk a lot about CapEx, especially in the last 2 or 3 webinars. We are also monitoring growth, earnings reports, forward-looking projections. All those things are important. We talk about CapEx because that is the amount of money these companies are, basically putting into research, development, data centers, growth of their industry, their space, their company. So if CapEx remains high, essentially what that is telling us is they're getting return on their investment for the vast amount of money they're pouring into this research and development, data centers. So it's working right now, right? So what we worry about is at some point, could there be diminishing returns? Is throwing 200 or 300 billion into a problem set and you're not getting the returns that you were getting before, then it starts to slow down, right? So like that CapEx spend is feeding, it's almost like a self-fulfilling prophecy, is feeding growth in the space. And so we want to continue to monitor that, watch CapEx, because these companies, if they start to slow on research development, things that they're doing to grow their companies, grow their industries, then they're seeing the writing on the wall that the growth, the spend isn't worth the growth. Anything you want to add to that?
Yeah. Just to add, if you kind of, going back to the .com, the late 90s, a lot of money was spent on getting the internet going. And part of the problem then was, how do you monetize it? How do you monetize the internet? When that was new, people were spending all kinds of money, but they weren't monetizing their investment. And that's what caused the problem. If you look at AI today, there's a lot of money being spent on it. But, ask yourself the question, how much money have you spent on AI? It's free for the most part. You use it kind of like the internet was, and they're trying to figure out how to monetize it. So right now there's a lot of companies spending money on it. If the solution to make money off of their investment doesn't come, well, then their investment's on a slow, right? Which will slow, the whole train down. So right now, we, as a firm, we've spent money on AI, solutions, but not that much. And most of what we consume it doesn't cost anything. So that's the issue. They're spending a lot of money, but right now they're not monetizing it.
Great. Well, we appreciate you all taking part of your Tuesday to spend it with us. We'll do this again next month. If anything pops up in the meantime, reach out to us directly. We'll answer your questions, go through your portfolios, whatever you want to discuss. And if you have topics you want to see us look at in the webinar or questions ahead of time, submit them to us. We'll take a peek and see what we can do.
Yep, we're looking for new material.
Yeah. All right. Everyone enjoy their week. Thank you so much.
Thanks. Have a good day.